Hey everybody, Marty Mazar, good afternoon. It's the 7th of April, 2016. Just a quick commentary for you. You may have noticed the market sold off pretty big today, and it started out pretty much with force this morning. Seems to be a lot of chatter over the Japanese yen and the fact that it's appreciating against Japan's zero interest rate policy, which is interesting. What I've been preaching for a year now is that currencies always don't the currency valuations are not always consistent with interest rate differentials. Here's the yen in Japan, a place that has very, very low interest rates, even negative interest rates on some bank reserves. And you've got the yen going higher. Go figure. I think a big part of that, folks, is that people had been expecting the Central Bank of Japan to do everything in their power to devalue the yen even more than what they've already done. Therefore, there's been a lot of what's called a carry trade, where you borrow in yen because you can get money for virtually nothing. And then you go and invest that money in assets in other currencies like dollars or euro, expecting that the yen is going to go down relative to where it was when you borrowed, and then it costs you less to pay back the loan, and you pocket the difference in the currency that you invested in. Can be a very lucrative trade. It's a favorite of a lot of big hedge funds and so on. But when the currency goes against you, as the yen has, then it's like covering shorts in the stock market. You unwind those carry trades and you end up buying the yen back because you're afraid you're going to lose a lot of money if it continues to go up. And then that exacerbates the up move. So I think today could have been a whole lot of unwinding of carry trades. Now, that means you have to sell what you bought in places like Europe and the US. So that also could explain some of why the US market sold off so hard today, because there could have been money exiting the dollar and buying the yen. In fact, that's what happened because the dollar was down against the yen. However, that's the only place it was down. It was actually up. The Bloomberg Spot Index against 10 major currencies, including the yen, was actually up. And when you look at the pairs, when I looked at it earlier today, that was the only place the dollar was down. So I can also add to today's pain that maybe the market is expecting a counter trend rally because the yen is way overbought. And if people then sell the yen again, that's going to make the dollar stronger and exacerbate what had been a headwind for the U.S. market up until recently, and that's a stronger dollar. So, folks, I know I'm getting way into the weeds, but I think today had something to do with the technicals, with currency as well as with the technicals. And here I'll just show you the 1-year chart today. I've been talking about these levels here, and I said yesterday that we closed above that, and it'll be interesting to see if that becomes support if we can stay above it, or resistance if we go below it. I told you that the 2045 level in the S&P was important, and unfortunately for the bulls, we closed below that today. If that momentum continues, technicians are going to be talking about 2020 and then a very important 2010 level. These may turn out to be support for this market. You could see it bounce back and go higher from here. If we break down below that, then we'll be talking about trading even lower, and then we'll be talking about 2000 on the S&P and so forth. But right now, I'm just looking at these levels. So as I've been telling you folks, and I left up this MACD line down here, this had been giving me a bearish signal. And as I said yesterday, despite yesterday's impressive rally, and I thought it was pretty impressive from a volume standpoint as well, it wasn't great from a volume standpoint, but better than we've seen on recent up days. The market really rolled over today, and I think it had a lot to do with the yen, but there's one other point I'll make here before I close that could have impacted the market today. But this should be the bias, and this makes sense to me, as I've been saying. I've also been telling you there's a lot of short interest in the market. There's a lot of cash on the sidelines. There was a big outflow of equity funds to begin the year into bond funds. Now we're seeing equities selectively in the U.S. and in a big way in places like emerging markets, money coming back to equities once again. And if that continues, or if that picks up some steam, that could be enough to where maybe we buy off of some of these levels and we go back up again. Another thing that's been pretty much the narrative the last couple of days is yesterday the Treasury creating basically a ruling or a law that really killed the Allergan-Pfizer tax inversion deal. There was some commentary today that suggested that they were going to continue to take greater measures to get in the way of some of those deals. And during the day, there was a report that there was a misquote, that actually the statement was, if we decide to do that, here's how we may go about it. Once that if was made apparent, then the market actually rallied a little bit off the lows. We were down, I think, 220 at one point. The Dow closed, I think, down 170 points. I know the S&P was down 32 and it closed down 24.75. And it seemed to bounce coincident with that news, that there was not just this huge commitment necessarily from allowing companies the freedom to change their tax regime, if indeed they can do that. So we'll see, folks. The rhetoric on the political podium is just virtually unbelievable when it comes to the disdain for business and Wall Street, et cetera. And I don't want to get into that because I have some very strong opinions there, but it won't do us any good in terms of this presentation. So I would still have to say my near-term bias would be to the downside. My longer-term bias is to the upside. A lot going on this year. I can make a case in both directions. And so I'll close today saying what I did yesterday, and that is expect a lot of volatility in both directions as the market figures itself out going forward. Have a great day. Thank you, as always, for watching and listening, and I'll talk to you again very soon. Bye-bye.